Thank you very much, all four of you, for coming to give evidence to us this afternoon. We have a lot to get through, and I'd like to start with Scotland, which is particularly topical, and given your remarks yesterday, Governor. Of course, in a sense, you're speaking not just as the Governor, you're also speaking as someone who's been here before with the Quebec experience from Canada. And in that sense, you're uniquely well placed, Governor, to comment on all this. And so, bad luck, we are going to persist a little today with some questions on this. Because I think you are very well placed to tell us how it really is and what this really means. You came before us in March to discuss the currency, to discuss currency unions, and you said then that that would require very stringent controls on tax and spend and would result in a loss of domestic control for an independent Scotland, some loss of sovereignty. I don't want to discuss that option today. In any case, the major parties have taken it off the table. What I'd like to address is the other possibilities, a number of the other possibilities that have been raised. Could you perhaps begin by giving an explanation of what you see as the major issues involved in sterlingization?
Okay. Well, thank you, Chair. And let me first acknowledge that what we all know, this is a particularly sensitive time, and obviously we have a responsibility to give our testimony. I am quite intent on limiting my testimony to testimony consistent with previous evidence. And so we had a discussion, as you said, quite an extensive discussion in March. Now, I'm not sure everyone paid as close attention to the discussion in March as the members of the committee.
They're listening now.
They may be listening slightly more carefully. And Mr. Norman and Mr. McFadden, others, Mr. Hosey, others asked questions around this issue yourself as well. So let's take sterlingization, by which I'll define as unilateral adoption of sterling. And I'm going to speak in general terms. So unilateral adoption of someone else's currency. So there's not those institutional structures that might be in place as part of a currency union. There's not a formal banking union. There's not a common central bank. There's not any fiscal arrangements in place. So what's required to maximize the prospects for, and I'll use the term sterlingization, but I'm speaking generally for sterlingization or dollarization. The first thing is, similar with the currency union, is having similar economic structures, similar business cycles, something that would mean that for the entity, for the country that's unilaterally adopting someone else's currency, that monetary policy would likely be, most times, consistent with the requirements of that country, so there wouldn't be that tension. Consistent with that, it would be in the interest of the country adopting that they maintain free flow of capital, goods, services, people across the common borders, which also helps smooth out fluctuations. But what else is required, would be required, and it's a question of degree, are institutional buttresses for the financial system of the country that's adopting the other's currency. In this case, an independent Scotland adopting sterling. Those institutional structures that we discussed include a lender of last resort, a credible lender of last resort, central bank. Secondly, a credible deposit insurance scheme. And I'll say that the credibility of those institutions is in part a function of the credibility of the fiscal structure, the fiscal credibility of the country, because deposit guarantee schemes are never fully funded. They rely ultimately on the fiscal resources. And central banks, including in the United Kingdom, often rely on the fiscal resources of the country itself. So, for example, as you know, as chair of this committee, if there's ELA required, that is a joint decision with the Treasury, and the chair of the TSC is informed. So there needs to be fiscal resources in there, and so it's the credibility of the fiscal resources, the credibility of those institutions, and that is also a function of the relative size of the financial sector relative to the size of the underlying economy, the fiscal resources. And the third element, the third broad element that is often required is the prudential standards. The prudential standards for the banks, the financial institutions in the country. So the capital requirements, liquidity requirements, and one can look at various examples. There tends to be much higher capital requirements, higher liquidity requirements in reality, not just requirements, but on the actual balance sheets of the banks in the country that has adopted someone else's currency unilaterally. Maybe the last point I'll make is that these are always questions of degree, and there are various examples around the world of this. The extent to which these supports need to be put in place, reinforced, built up, is in part a function of the similarity of the economies. It's in part the function of the sophistication of the financial system. It's also a function of the extent to which that financial system is cross-border. And finally, it is a function of the extent to which the adoption of someone else's currency is part of a process, I would suggest, and we did have this discussion in March, is whether that adoption is part of a process of convergence or divergence, because that again goes to the question of the longer-term credibility of the arrangement.
Well, just on that last, the Eurozone is part of a process of convergence.
Yes.
How would you characterise likely sterlingization of the UK divided into two countries?
Well, I would say that there are economic criteria of convergence in the Eurozone. There are also political criteria of convergence. It's not for me to comment on the political.
I'm asking about the
on the economic. Obviously, the economies of Scotland, the rest of the UK, are highly integrated. There's fairly strong convergence, although, as I outlined in my speech in January on this subject, in terms of the dispersion of the industries in Scotland, it's more towards the Canadian end of the spectrum, which is more dispersed, than it is towards the European end of the spectrum, which is more similar. The question is, what happens over time? Do those differences build up over time? There's some evidence that once you put borders in place, they build up over time. But
is there any evidence that there is convergence if you put borders in place?
Well, I hesitate to speculate on
right.
events.
I think we can assume that there will be divergence, can't we, Governor? How much is a matter of speculation, but there will be divergence.
I think it is fair to say that the question before the Scottish people, by design, has an element of divergence, yes.
Can I just take you through each of these areas in turn briefly? The lender of last resort problem, how might that resolve itself?
Well, this
is the question, when a financial institution gets into trouble, is there anyone
yes.
in the event of a crisis where you deem that there is contagion risk, is there a mechanism for bailing it out, and if so, how is that accomplished?
Yeah, and the lender of last resort, as in the case of the United Kingdom, virtually the case everywhere, is the central bank. If the credibility of that role relies on the strength of the balance sheet of that central bank. That can be a function of the capitalization of the central bank. It normally is also a function of access to other capital resources. That can be the right to get seigniorage from the currency. That's future income. We don't have that here, and I presume I'm not going to be given time to make the case for seigniorage today, Chairman. But it can be a function of that.
For those who are listening who may be slightly confused, this is the Bank of England wanting to pocket some money.
On behalf of the people of the United Kingdom,
but do carry
for their
on.
benefit. Either seigniorage, but seigniorage, you do not get access to seigniorage on someone else's currency by definition. So that's not an option in the case of the unilateral adopter. The second way to support the balance sheet, obviously, is through capital. That's expensive. That's an investment. It's a fiscal cost. And the third way is to provide some sort of indemnity or backstop, which is the way things work in the United Kingdom, which is a contingent responsibility of the government, and therefore is a fiscal role. So the lender of last resort, it's centered around the central bank, but just having a central bank isn't by definition a credible lender of last resort if that central bank is not the issuer of the currency. It needs to be backed up. It needs to be backed up in any event by fiscal resources, but particularly, and I'll stop with this, if it is the currency of another jurisdiction, those resources need to include access to that foreign currency, so some form of reserves in that foreign currency that are readily available.
Because after all, what we're here is talking about is using someone else's currency and then trying to accumulate reserves of a sufficient scale to give you credibility to be able to run a lender of last resort operation if the need arose. Is that correct?
It is correct that the reserves need to be sufficient
and they will be
and seem to be
risk.
sufficient for lender of last resort, but also for to back the credibility of the notes in circulation. Either they back one-to-one, that's at the actual notes in circulation, which would be sterling, or not just the notes in circulation, but broader money, so deposits, either demand deposits or term deposits or other aspects of broader money that would be denominated in sterling. They would, again, it is a function of an overall set of structures, how credible that broader money is backed, how credibly that broader money is backed in sterling, a foreign currency, and that requires a certain amount of reserves. And those reserves, the size of those reserves, relative to GDP, relative to deposits, relative to broader money, have to increase the bigger the challenges are.
Right. So we have some empirical experience here. Give us an idea of those numbers. You've just cited three: reserves to deposits, reserves to GDP, and I think broad money was the third one you came out with.
Yeah. Well, I might ask, given the sensitivity and and the precision around this, that to be allowed to submit. Robust numbers, if I may, but I'll bring back to a discussion we did have.
I'm not holding you to particular. I'm just trying to get a ballpark sense of the numbers here, so we can carry on the discussion today.
Okay.
What kind of scale of reserves might be required, given the size, which is very large in relation to GDP, of the Scottish financial system, to provide a lender of last resort facility and something that can give credibility to deposit assurance, and also provide that extra capital cover you said might be required for the banks at the prudential level?
To take the entire range, there's a range to which I would not subscribe, but would be just backing notes in circulation. Notes in circulation in Scotland are backed one-to-one by Bank of England notes. So I'd make this point, given that people may be focusing on this. The notes in Scotland that circulate, issued by the banks today, are backed by the Bank of England, and that will continue. When you move to more broad sterling assets, so deposits at the bank, which aren't notes in circulation, term deposits, short-term deposits, demand deposits. When you look at other countries, the Baltic states, for example, as they were in a process of convergence with the Eurozone, the orders of magnitude of reserves, helped by the IMF and others, the orders of magnitude of reserves would be on the order of about 25% of GDP.
Okay.
As the degree of sophistication of the financial system increases, the degree of the cross-border element of the financial system increases, the ratio of financial system assets or liabilities, which is relevant for central banking, to GDP goes up. The amount of those reserves goes up as well. And we had a discussion here in March about Hong Kong, where you have a sophisticated financial system large cross-border activity, large relative to GDP, and a longer-term process of divergence with their currency of choice. They peg to the US dollar, but obviously as with the rise of China, the internationalization of the RMB, one would expect that over time that's a more natural relationship. Hong Kong's reserves a little more than 300 billion US dollars. From memory, that's 110, 120% of Hong Kong GDP. So you move along the spectrum, so it refer back to my answer at the start, which is that it's about the credibility of the institutions that back the unilateral adoption. That goes to fiscal. It also goes to the size and sophistication of the financial system, and those dynamics.
Okay, let's just tackle each of those in turn just briefly. You've given some idea of the scale of the reserves, which is very large, and particularly large that would be required, and is very large, particularly large if you've got a large financial sector. How might one accumulate those? Let's take the Scottish case. What kind of reserves do you think they're likely to inherit were they to opt for separation in the referendum?
Well, you go back to reiterating recognize the sensitivity of the time, recognize the political decisions and the political discussions, negotiations are quite rightly in the political realm. So let me just observe a few facts without comment on.
I'm only asking you for the facts, and I will try and resist colleagues' attempts to get you to do something which you feel would be inappropriate as governor in this area.
As I referenced earlier, the notes in circulation, so the actual banknotes, the physical banknotes that people in Scotland and we use when we're in Scotland, those are backed 1-to-1 with assets with the Bank of England. So in effect, they are backed by the Bank of England. Okay, order of magnitude of that is it's a little more than 5 billion sterling of reserves. You can look at that as a pool. The subject for negotiation. A subject for negotiation, I make no comment on it, would be the division of the debt and the division of the reserves of the United Kingdom, which would include reserves potentially reserves at the Bank of England. Now, there's about 6 billion of reserves at the Bank of England. The question, how much of that would be apportioned? There's a little more than 60 billion sterling equivalent of reserves at Her Majesty's Treasury. So
that's another 5 or 6 if one.
On a GDP
or a GDP
basis,
you get to roughly the same answer.
Yes, order of magnitude. Yeah.
So we're getting to a number about 15 billion, 15, are we?
Well, that would be a higher number, yes. But
I'm just totting up the upper end of the numbers you've given me, I think. That would be the upper end of the range, yes. Okay.
And then subsequent, I think may I make the general point, which is that it is reasonable to expect that countries adopting currency would have to build reserves by running, and these are fiscal costs, so you have to borrow to build these reserves, and it's real money. And further, you have to run it. In effect, you have to run a balance of payments surplus in order to build, and a balance of payments surplus in order to be the net of your current account balance and
but you've got to run both,
balance.
Haven't you?
You have to have both to sustainably build.
So we just concentrate on the budget surplus. What we're talking about here is higher taxes or cuts in spending, aren't we?
I mean, it's. I make no comment on the fiscal stance
because the borrowing side is very tricky.
May I say it's a question of priorities for the government.
But I just want clarification.
But it would be
a triangle that fiscal consists of fiscal policy. Makes up fiscal policy. You've either got to put taxes up or you've got to cut spending to find this budget surplus. Have you not?
You have to make decisions about the priorities of consistent with the currency arrangement you wish to adopt unilaterally.
Okay. What do you think the prospects would be for borrowing from markets to obtain the necessary capital? That's these reserves that are going to be required. I think we've concluded that the reserves are not there at the minute in anything like the numbers required. Maybe we ought to throw in one extra number. Roughly, what do you think, what would you estimate the assets in the Scottish financial sector to be?
The assets, broad brush assets in the Scottish financial sector, Scottish domiciled entities, about 10 times Scottish GDP.
Which is, in absolute terms?
Would be north of £1 trillion sterling.
About £1 trillion. So we've got £1 trillion sterling, and we've got what in reserves at the moment?
Well,
didn't like my
we're speaking in counterfactual terms about, but the.
So what ratio are we getting to here of bank deposits to reserves for Scotland at the start?
The deposits of Scottish domiciled banks. So those are Scottish domiciled banks, which would include, and the vast majority of those deposits would be deposits in the rest of the UK, are a little less than 800 billion sterling at the moment. So the judgment, depending on other factors, institutional arrangements that might be put in place, fiscal credibility, would be what's the relevant size of reserves that would need to be built up to be consistent with the responsibilities of an independent Scotland as lender of last resort and as backstop for the deposit guarantee scheme. Now, there's a question of the circulation of currency in Scotland, not currency, broader money in Scotland, and the backing of broader money in Scotland, which is less than that, but the credibility of the backstops would have to be established. I would, though, if I may, refer back to my testimony in March, where a number of members asked about the potential dynamics and the responsibilities of both Scotland, rest of UK, and very importantly the financial institutions themselves in the event of independence, and in the event, and it's a joint probability, and in the event of Scotland remaining a member of the EU or the EEA, because there are responsibilities under the so-called CRD4 BCCI directive about potential redomiciling of institutions. So that dynamic may come into play. I'm not trying to be obtuse about it. That's just it's complicated, but it's there. I would just, in terms of orders of magnitude, I just refer back to the broad brush examples that roughly a quarter of GDP, it's sometimes easier to look at GDP, a quarter of GDP
is required. Countries,
process of convergence, relatively younger financial sectors, less cross-border, up to above 100% of GDP for bigger financial sectors relative to the economy, processes of divergence, large cross-border activity.
Is required in order to...
I would say are held. And I say are held. Those are discrete decisions
in practice. Decisions they've taken.
Yeah.
And that's what they've got in order to deal with the lender of last resort problem and the deposit guarantee problem and the need to provide capital to underpin their financial institutions.
And to
is that correct?
It is
helpful if you could just say.
I would generalize it to make the credibility of the adoption to fully ensure the credibility
and to bring adequate credibility to the system.
And ensure that credit flows freely and effectively.
Okay, and what is that ratio in Scotland?
Well, I'm not going to. It's
at the moment.
I'm not going to make a judgment about what that would be. Scotland, I can't say at the moment because obviously Scotland doesn't have a reserve. On your calculation,
well, I was
on your calculation, I'm not making a calculation.
For numbers, and then totting them up, and we got to something south of 15.
The Scottish GDP, 106 billion.
Okay.
You can make
so
the judgment.
that ratio looks to be rather different from 25%. I can't work it out off the top of my head, but it's a lot less than 25. So, yes.
Yeah.
So it's a very low multiple. Perhaps after this meeting, you could send us a piece of paper with those two sets of numbers, backed by some examples, just factual.
The factual, if I may, Chairman.
Factual numbers. Would that be possible?
It was certainly possible. We will send the numbers that are factual on other countries and remind the committee of what they know, the size of the Scottish economy. I don't think it would be appropriate for us to make any assumption about the apportionment of existing reserves. And if I may just reemphasize the final point for those who aren't following the technicalities of this, and these are important technicalities, but in terms of Scottish notes in circulation, they are backed and will be continued to back through the end of the transition period.
And we're not talking here about the transition arrangements.
No.
We're both having an exchange, I take it, about what the state of play will be at the end of the transition arrangement.
That is very much so, and maybe I should just take this opportunity. As you well know, the Bank of England has a range of responsibilities for financial stability. We're not solely responsible, but we have a range of responsibilities, including lender of last resort and other aspects. Those responsibilities would continue through a transition period. The question is what happens beyond the transition period if that were to come to pass, and that is what we have been discussing. So I'll just re-emphasize that point. So we're not talking about the short term.
I understand.
We're talking about the
longer term,
yeah.
the new arrangements in the longer term. Can I just clarify one other point? In fact, I've got more than one I want to clarify, but just on this accumulation of reserves point, you said, I think we both agreed, we'd need to run Scotland would need to run a current and a balance of payments, surplus and a budget surplus in order to start accumulating the necessary reserves that they could borrow from markets. Are there any other options open to them? Might they do, for example, what a large number of countries have done who have found themselves as new countries, and which Dr. Shafik will have a lot of practical experience of, but I'll keep the questioning with you for the time being, Governor, which is to ask the IMF for some support.
I wouldn't presume to advise a hypothetical independent Scottish government on how they would find the resources, but there are market resources, there are multilateral resources. But I think the core point is ultimately borrowing from whoever is a transition. It's a smoothing mechanism. These are real fiscal responsibilities, real fiscal costs. Ultimately, it's about the underlying resources of the state that's adopted another currency and the ability or the credibility of those underlying resources in backing that decision through the financial system because of the responsibilities that they take on, and not limited to lender of last resort and deposit guarantee.
There is an alternative to accumulating reserves, at least to deal with part of the problem, which is a large financial sector, and that is that which you touched on very briefly, which is that the financial sector migrates to obtain lender of last resort cover somewhere else, isn't there?
Well, the extent to which the financial sector redomiciles, migrates, the scale of what is required correspondingly reduces. Yes.
And with that comes a loss of foreign exchange earnings, and therefore it makes the current account issue that we were discussing a moment ago somewhat more difficult. And of course it comes with employment losses as well, does it not?
It could. I mean, it's.
Yeah, I won't persist.
Yeah, I don't want to.
I can see your hesitancy, and I'm not going to persist. Can we just also touch on another approach that has been considered, which is the fixed peg Danish option? This is they in their case have got a fixed peg with the Eurozone. That presupposes very large reserves to enable intervention to support the parity, doesn't it?
Yeah, yes, it does. It also benefits from the tight integration of the economies, and I would say it benefits from some of the other institutional structures that I reference, economic and institutional structures. But there are considerable reserves, and I can provide you for the precise number. I would say from memory it's a third to 40%, somewhere in that order of magnitude of broader banking, broader money, so broader banking liability. Perhaps
for these sets of examples that you're going to send us, it would be helpful to have these numbers set out for the three main ways in which you thought it might be helpful to measure this: broad money, GDP, and I think it seems to me anyway that bank deposits,
underlying deposits,
are a useful measure. But that's a tough option, isn't it, the Danish option, because you've got to get even bigger reserves and got to build up credibility. You were talking about credibility, which has to be accumulated over time in a fixed peg system. That's hard won, is it not, generally, for countries in currency markets?
It has to, well, it has to be earned, yes.
If we put this whole picture together, are we not concluding that there are other options, but they're tough and they require a great deal of hard work, the building up of reserves, which may mean budget surpluses, and the establishment of credibility, and alongside it the risk of migration or part or all of the financial sector. Is that not correct?
Well, I don't want to make a value judgment on the decision in any way, shape, or form. Certainly any currency arrangement has to be adequately supported, has to be credible. The cost of not having that credibility is considerable. So it is a judgment for the relevant authorities what best suits their economy and their broader circumstances, and it's an economic judgment, and to the extent to which it has fiscal implications, it is a judgment about the priorities of that authority. Yes.
Okay, that's very helpful. Thank you very much, Stuart Hosey.
Thank you, Chairman. Governor, can I thank you for what you said at the start, the recognition that this is a very sensitive time, and I'm not going to probe too much into detail precisely because of that. And also that the answers you've given, you said, were consistent with what you've previously said. And I also want to dwell on that. When you were before us in March, answering questions on the speech you gave in Edinburgh, you said the speech and the bank's approach to this issue has been and will continue to be a technocratic approach. It is for others to address these issues, and it's ultimately a decision for the Scottish people, which will be taken in the context of many other aspects of the broader issue. So can I just confirm with you that that remains you and the bank's position today?
Thank you, Mr. Hosey. Yes, very much. We recognize this is one of many issues that are under consideration.
It is important in terms of the Kremlinology over what's said, particularly by yourself at this point, that's absolutely clear. You also, at the hearing in March, described in detail to a number of members of the committee what would be required to make a formal currency union work, and you gave a number of examples of how it's happened elsewhere. You spoke about free movement of labour across the border, free movement of goods and capital. You spoke about the fiscal arrangements to smooth fluctuations. You spoke about the underlying structures of the economy determining the extent to which there was alignment, and many other aspects of what made a currency union. So can I confirm that nothing you've said since is at all incompatible with that? Indeed, the remarks you made at the TUC conference are absolutely in line with the testimony you gave in March.
You may absolutely. I'll be clear. I'll refer as well to my speech in Edinburgh. My testimony in March was consistent with speech in Edinburgh, and I noted at the time that being part of a currency union requires some ceding of national sovereignty, and I was responding to a question, so I didn't use exactly the precise ordering of the words, but the point was the same.
And I think when we discussed this matter in March, the other ways in which you described that in your speech were sharing responsibility, pooling resources. There were a number of ways in which you described that sharing of responsibility.
There are ways of sharing responsibilities. I will say, and I'm on record, and I've been on record for 5 years on this point, since the start of the Eurozone, difficult Eurozone crisis, let's be frank, that one of the lessons of the Eurozone, to me, consistent over years, consistent in the speech, consistent in March, has been the need for some form of fiscal arrangements between the constituent parts to help with the inevitable fluctuations. And I will say, just so we're absolutely clear, that is a point of generality, in my considered opinion, over the medium term, that the euro area is going to have to build deeper fiscal links across the member states than currently exist in order to have a truly viable and effective currency union for the euro.
And the third question on this theme, and you've already alluded to it today, is what you said at the Inflation Report monthly press conference on the 13th of August, that in terms of financial stability questions, I reiterate that whatever happens in the vote, the Bank of England will be the continuing authority for financial stability for some period of time, certainly over the interim period, and we look to discharge those responsibilities accordingly. And that is absolutely the case today. That hasn't changed at all. That
has not changed, and I just for absolute clarity, I made that point earlier. We are given our responsibilities by Parliament, and we discharge them. And we will be, we are the main principal authority for financial stability, not the sole, but the principal authority for financial stability. In the event of a yes vote, we would continue to be that authority for the transition period, which is under the Edinburgh Agreement, as you know, is 18 months. And I'll take the opportunity to say that we have, as you would expect, and we've been asked this by members of the committee in the past, Mr. Norman and others, we have been doing contingency planning. We have contingency plans, and we would obviously implement them if at all required in the short term to support financial stability. The issues that the chairman was addressing are medium-term issues that go beyond that transition period, which you understand.
Absolutely right. Listen, just one final question. You described the size of the Scottish financial sector as in a quantum of around 10 times GDP. I've seen a number of figures of that nature. I think your GDP figure for Scotland, 106 billion, was rather low. I think it's closer to 145 onshore and offshore. However, that's neither here nor there. The question is, in terms of the quantum in relation to GDP, you are aware that's a contentious issue in the sense that the figure published by the UK government would tend to include a substantial number of financial assets which are and always have been headquartered in London. Just for clarity, you're aware that this is not a figure which is universally agreed.
For clarity, so we're on the same page, I rounded down to 10.
Yeah.
I apologize for the 106, but then also for clarity, there would be some discussion of the apportionment of the offshore, as you know. Under European law, the responsibility, the ultimate backstop for those assets is not where those assets are, it's where they're headquartered.
Indeed.
And so my calculation is based on where these institutions are currently headquartered, which is why issues of redomicile and change become relevant. So the responsibility of the lender of last resort for independent independent Scotland, for an entity that is headquartered in Scotland, regardless of where its deposits are in the European Union, European Economic Area, is a responsibility of the Scottish state, the ultimate backstop there. So that's why that figure is relevant to the issues that we were discussing. If you take the point in time, I'm for obvious reasons, Mr. Hosey, I'm not going to speculate about potential changes in domicile. But let me reinforce the theme of your questioning, if you will, which is that my response to the question of the TUC yesterday, my testimony here is entirely consistent with my testimony in March and my speech in January, and those two, I believe, was consistent. Maybe some of the adjectives are different, but the points are the same.
That's extremely helpful, Governor. Thank you very much.
Just on the document that you're going to send us, it's just a factual document. Will you be able to get us that?
By first thing tomorrow morning.
First thing tomorrow morning, that would be very helpful. Thank you. I think we've got Steve Baker.
Governor, I'm persuaded today not to ask you about the common monetary history of Canada and Scotland, but I'm glad that the issue of Scottish banknotes and why private banks issue their own notes has come up. Perhaps we'll return to it one way or another after the referendum. But just to move on to productivity and wages, looking at the MPC minutes, it says that excluding the years after the two world wars, current data indicated that the recent period had been the slowest rate of productivity growth over any 5 years since at least the late 19th century. So has the economy been fundamentally changed by the financial crisis, and how? And since you've said so much, may I perhaps ask Professor Miles to begin?
Yes, I think the financial crisis has had a permanent impact on the economy. I don't think we're going to get back some of that, what you might call lost productivity, which is very large. We're probably maybe 12-13% lower level of productivity than you might have thought if you just carried on a straight line through 2007 to today. Unfortunately, I don't think we're going to get most of that back. I'm a bit more optimistic, though, that we may return to something more normal in terms of the growth of productivity. So I don't think the growth of productivity from here on forward should necessarily be lower, but I think we've had a permanent hit to our standard of living.
But shall I just pick up on that one point? You're talking about the straight line growth in productivity. Could I just refer you to chart 2.2, which is about, it's on page 19. Household consumption growth has been outpacing income growth. And just looking at it, you can see there's a spread between consumption and income growth. And then there's a particular discontinuity around the crisis, and then again we've seen the growth coming up. Do you think we've been too dependent on credit, and do you think that has fundamentally changed over the course of the crisis?
Well, I mean, very recently the flow of credit to the household sector has been pretty subdued, and as you'll know, mortgage lending really has been running at very much lower levels than we had before the crisis. So we have had a slight reduction in the savings rate over the last few years, and that's held consumption up in the light of really significant falls in real incomes. But I wouldn't describe what's happened over the last few years really as being fueled by credit. It's more that people have just reduced their savings rate a bit, but not through borrowing.
Dr. Wheal, did you want to pick up on this? How the economy has changed and whether this issue of the spread between consumption and income growth is relevant?
Well, I think, no, at least what is important to me is what seems to have happened to the supply side. And how consumption is financed may affect things in the short term, but you wouldn't think it could have very much of an influence in the long term. Like David Miles, I take the view that we probably won't make up the lost ground for quite a long time at best. The question is whether the productivity growth rate recovers to the sort of thing that we'd been used to before the crisis or not. And there you have different indicators pointing in different directions. On the continent, before the crisis, productivity was growing rather more slowly than at home. One can make the argument that in the period before the crisis, there were some factors pushing up on productivity, most notably the way the financial sector was measured in the national accounts, and there's no right answer as to how to do that, but part of the volume of the output of the sector was measured with reference to the volume of bank deposits. Now, it's quite easy to increase the amount of bank deposits without needing any more hours worked. So that was pushing up on productivity, and conversely, the fact that process has stopped has pulled down. Could I just say one other thing, that there is a new set of national accounts coming out at the end of this month. We have seen a trailer of them, which I certainly haven't fully absorbed. I think it is likely that they'll show, but based on the trailer I've seen, I should say, not on any private information, I think it is likely that they'll show that the productivity story has still been bad, but not quite as bad as we had thought.
Well, you slightly preempted my next question. And Dr. Shafiq, perhaps you could comment on the extent to which that change in the national accounts explains what's happened to productivity.
I'll start by saying there is a view that some of the productivity that we saw in the past, pre-crisis, was unsustainable because it was based on high rates of leverage, and some of those growth rates that we saw were probably unsustainable, and therefore we shouldn't expect to see productivity go back to the levels that we saw pre-crisis. I think the committee is very familiar with the work that the bank staff have done to try and explain the 17% loss in productivity relative to trend in the Quarterly Journal article. Some of it's measurement error, some of it is lowered levels of demand, some of it is substituting labour for capital because wage growth was low. I think some of that productivity loss we will recoup in the period ahead. But there are some other fundamental changes that have happened. For example, in the composition of the labour force, the increased numbers of older workers, for example, who might be a bit less productive, which will mean that the recovery of productivity may not look as robust as what we saw pre-crisis.
Thank you. I particularly wanted to pick up on this issue of the substitution of labour for capital. If I may, page 21, chart 2.6, which is about the capital stock, and also page 27, chart 3.7, which is about whole economy capital services per hour. What I see there is that capital stock rose between, say, 2007 quite markedly before broadly stagnating, whereas if you look at the capital services per hour, there was a sudden peak from 7 till 9 and then a collapse in the capital services per hour. Can you try and tie together what is going on there with the stock of capital and the level of capital services per hour with real wage growth? Governor, if I may.
Sure. Thank you. Thanks for the question, because I think you're hitting an important point. And I tried to provide some more analysis around this in my speech yesterday to the TUC. It was the bit that wasn't reported, but this is a crucial point, Mr. Baker. There's a period. And this does not explain, and you're not suggesting that this explains the whole productivity puzzle or will result in ratio shortfall, and I certainly subscribe to what both Dr. Wheal and Professor Miles said about not recovering that. That said, what appears to have happened, I also subscribe to what Arden Wheal said about the importance of focusing on the supply side. And we are very focused on, in terms of the shorter-term dynamics on the supply side, and what we have seen is that there has been a labor supply shock, if you will. There's been more people looking for work, looking for more work, staying in work longer. We have quite a marked, and it's noted elsewhere in the report, split in terms of the participation rate, the actual participation rate in the economy versus a sort of batting average of the participation rate if cohorts had followed the previous levels of participation as they progressed through. And the consequence of this has been to help keep wages down, and firms seeing low costs of work or hiring relative to new investment, substituting labor for capital. I would add, just to link back to your financial crisis point and the financial impacts, that obviously the period of time over which the financial sector has been healing, the cost of capital and the availability of capital, we all know, has been the cost has been higher, availability has been lower. So again, that tilts the balance in terms of substitution of labor for capital. You see, as you rightly point, the net impact of that, and that could account, one would think, for some of the reduction in output per hour at a time when GDP is growing. Now, to finish the thought, one gets a labor supply shock, that has an effect for a period of time until that labor is absorbed. And what's consistent with our forecast is that as that labor is absorbed, wage growth begins to accelerate, investment continues to increase, productivity picks up, and I would say we have quite a modest pickup in productivity, quite a prudent assumption for the expectation of productivity pickup over the forecast horizon.
I want to come back to something else you said in your speech, but just on this point about investment picking up. Do you feel when we're talking about business investment that we drill into enough detail about business investment in which sectors and at which stages of production? Because there's a chart in here somewhere, I think, in fact it's in relation to chart 2.6, there's a comment that excess capital is, it is possible that excess capital is concentrated in only a few sectors. So the question is, do you think we collect enough information about where this capital is, both sectorally and in terms of stages of production, and would that help to explain what's going on with both the capital stock and the other points that we've just discussed?
Well, we certainly, let me make three points. First, obviously, what we're charged with doing is managing monetary policy for the macro economy. So the aggregates matter. I mean, there are always bottlenecks, and there are always adjustments across sectors. That said, we do drill down into sectors. There's been some work by one of our colleagues, Ian McCafferty, and certainly by staff, and we've looked at various sectoral compositions of all of both the productivity shortfall, but also where there are bigger bottlenecks. And others, we get regular reports from our agents, we go and visit businesses, et cetera, so we do look at that. But I think your point, there's a richer element of your point as well, which is that it's not just about capital investment growing productivity. I mean, increasingly process changes, intangibles, other elements that to some extent the national accounts are pulling in, certainly on the R&D side. That will be one of the revisions which we will see. We'll see an adjustment in the investment level because they're pulling in R&D. But it's extremely difficult as a statistician to pull in these other elements which are effectively booked as operating costs, but are investments in productivity that is or more consistent with this type of economy. So you can run a more capital light economy certainly today than 20, 30 years ago.
I think I'm coming at this from a Hayekian perspective, which believes that we aggregate away much of the detail that matters. And I'm looking at your speech to the Monetary Policy Forum in New York, where you explained that the stronger critique of the Austrian school was about inflation targeting, was about its it's in relation to capital. I'm not going to go through it now because it's not that interesting to committee. Perhaps we can discuss it another occasion. But,
teasing me with two issues I want to discuss.
I think that is clearly where I'm coming from. I think we're aggregating away detail that matters, which explains this productivity puzzle. I mean, I just want to put two other points to you.
But may I say, Mr. Baker, I don't think we're aggregating detail that matters from an inflation perspective.
Yeah. Okay.
Unit-wide labor costs. Unit labor costs, average wages across, average productivity, average unit labor costs, that ultimately are key determinants of inflation. And so those are judgments. Now, we're going to make different judgments as members of the committee, as you would expect, about those variables, but it matters, but the question you have to ask is from an inflation perspective.
I'm conscious I want to ask you two questions while I can still get away with it, but I just refer to the beginning.
If you could be brief, would be very helpful.
The two other points I'd like to make is, one is that I've listened to my dear friend Professor Kevin Dowd argue many times that a policy of easy credit is a policy of capital consumption. Do you think there's any merit in that argument?
It's an aphorism that I'd like to see the detail.
Okay, what are your other?
And the other point is, to what extent does regime uncertainty,
Yes.
the notion, things like forward guidance and people having to look very carefully at what you're likely to decide about interest rates, to what extent does regime uncertainty produce prejudices in terms of outlook and confidence against investment in real
Well, I would say, and I wouldn't overinterpret this, but I would say the evidence and certainly the experience since at least the first phase of forward guidance was put in place has been at least correlated with a pickup in investment, a sharp pickup in investment consistent with it, which would go actually to the opposite, that providing some degree of certainty in terms of the appropriate degree of certainty in terms of the stance of policy, which was harder, it was clearer and more absolute with forward guidance 1 because there was a threshold subject to certain caveats. With forward guidance 2, it's more about the medium-term path, but that is provided, not surprisingly, guidance, but also some comfort to business. And look, we picked this up on a survey basis, and I won't overplay it, but if you tried to make the case that putting guidance in place was associated with slower investment growth, it would be impossible with the data that's sitting in front of you.
Thank you very much.
Thank you.
Jesse Norton wants to come back to Scotland.
Mr. Chairman, if I may, I've just got a couple of questions about Scotland before then I'll come back later to my other questions. When you met us earlier in the year in March, Governor, I asked you whether the small size of an independent Scotland's economy, roughly a tenth of the size of the UK, and its exposure to oil and gas sectors might make it a more volatile economy as an independent. And you said, and I'm quoting, the performance of the Scottish economy relative to the rest of the UK is more volatile because of the industrial structure, which is consistent with what you've said today. If you look at dollarization, sterlingization, as you will be aware, there are three categories, broadly speaking, into which countries which are dollarized fall. One is tiny city-states, Andorra, the Vatican, people like that. Second would be states who are in transition, like Montenegro and Kosovo. Okay. Third would be countries which have a legacy of economic or political instability, like Panama, Ecuador, El Salvador. Okay. So Scotland, if it were to sterlingize, would be by far the largest and wealthiest country to do that. Okay. Is that your view as well, just to be clear?
I would add to your list countries engaged in a process of convergence, and I'm making the example. I'm extending your dollarization, sterlingization, if you will, to euroization or pegs or currency boards to the euro in order to converge to the euro. That's not what we're talking about here, but just so we have the complete range. It is, I think I'm safest to say, it's relatively unusual to, given the direction of, given what's implied by the question in the referendum, that is a relatively unusual circumstance in terms of to maintain the currency. Yes.
So it would be relatively unusual for a country this size to have dollarized or sterlingized, i.e., to operate a process of using another country's currency. I mean, that's what you just said.
Yeah, it is. Yes. I would say what I was honing in on your point of the point at which it happens. So, for example, and we can. I know I'm not going to get into political definitions. I mean, Hong Kong is of the same size in GDP. Right. It is dollarized. But I think we've had an exchange on that today and back in March in terms of the circumstances there and the requirements that are put in place.
But just to be clear, your answer to my first question was yes, and we're now talking about Hong Kong, which doesn't have is not a pure dollarized, it's got a currency board, it's a slightly different setup. What's interesting about Hong Kong, though, now that you have raised it, is, as you know, it has $300 billion of foreign exchange reserves, and it operates a policy of holding reserves at something like 30% of GDP. Now, if Scotland were to follow the Hong Kong example, with 150 billion pounds of GDP, it would be holding 45 billion pounds of reserves, would it not?
That is the straight.
That's a mathematical outcome of following the Hong Kong. So it would be offering, am I right? 45 billion pounds of reserves.
As per the Chairman's request, we'll provide the sort of facts of reserves relative to size of GDP and broad money. But the backing, it is not uncommon. There are many examples of currency boards or arrangements of dollarization where those orders of magnitude of reserves are in place, yes.
Just wondered, okay.
And in that note, you're going to send us,
I'll
give us the
table.
rough orders of magnitude that we were discussing for Scotland without you necessarily saying, and I quite understand you don't want to because it's subject to negotiation, that would be Scotland's reserves. It doesn't need to say that. But that there is the seigniorage and the proportionate share of assets of the Bank of England, which you can give us as ballpark numbers.
Yeah, I think, Chairman, with your agreement, I think it would be helpful for the bank to give us those numbers for each of the classes that we've identified. So that
Three
someone
classes, yes, which is what I think the Governor's already agreed to do.
No, but for different countries, so that one can say.
Yes.
Yeah, okay, good.
And for each of these key countries, Denmark, Hong Kong.
As well as the smaller ones, so people can get a sense
wanted
of
to get a couple of
what's in
small
play,
ones,
yeah.
we'll add those as well.
The point I'm trying to get to, Governor, is just it's a mathematical point. It doesn't really require anything other than you're recognising the maths. But if Scotland is treated like Hong Kong and had a 30% reserves of GDP, it would have roughly 45 billion pounds worth of reserves. That's a mathematical fact. If that were the case, then that requirement for reserves would be 3 times the number that you've described as being the reserves in your answers to Mr. Tyree. And the difference would be of the order of 28 to 30 billion pounds so far unfunded and being required to be made up through the budget and balance of payment surplus that you've described with interim arrangements. Is that not correct?
I think given, if I may, what I would very much prefer is to stay in line with my previous testimony and speeches. And in that regard, we have discussed the range of institutional arrangements, economic characteristics that are consistent with currency union and also with sterlingization, unilateral adoption. We've also discussed the relative orders of magnitude of reserves in fact for various examples that exist. What I haven't done is provide in the past, and I do not want to today, an estimate of what might be required for Scotland in a hypothetical situation. So with respect, Mr. Norman, I prefer that we stay with the economics of it, which I think you have accurately described, and the facts that are on the facts that exist in other circumstances.
I'm grateful for that, and I understand. The difficulty with that is that the bank will not is essentially subcontracting out a decision or a judgment as to whether Scotland's economy is more like Andorra's or one of the European aspirant states or Hong Kong. And I can see why one might do that, but it has had the effect of extreme lack of clarity. And I think it would be helpful if you would say what I think is becoming clear, which is a very significant increase in reserves would be required.
I think it's
to sustain that. Am I not right about that?
I would make the point that the scale of reserves that a country that adopts another country's currency requires increases with the size of their financial system, the complexity of the financial system, the degree to which there's cross-border flows of their financial system. And there are many examples out there on which to anchor those calculations. It is also a function, as I said in, I believe, my opening response to the first question, it's also a function of the fiscal position of the country, the fiscal strength of the country, because that provides greater credibility the stronger it is. And it is, as we discussed in March, it is a function of the credibility of the arrangement. In other words, is it viewed as a permanent relationship? Is it or is it is there a possibility that is a temporary arrangement? And I summarize that in terms of, is it part of a process of convergence or divergence, which is a broader judgment.
Thank you very much.
But it is a fact, isn't it, that countries who are running sterlingization type policies with other currencies need very large reserves.
It is a fact that the size of the reserves is one of the
it's easier to say
one
yes
of the most
to that
important.
one.
Well, no, but it's a fact that it's one of the most important factors that determines the credibility. It's not the sole.
But it is a
factor
fact
that
that countries that are running successful policies of that type have large reserves.
yes.
Thank you. And it is a fact that at the start Scotland won't have very large reserves.
It's not for me to judge that. It's a negotiation.
Thank you. Governor, would you forgive me if I just, as a bearer of very simple brain, just picked up on one particular point, the last point that I made on the Scotland thing, and this is the sterlingization of it. Just if I can just cover one or two of your figures again. I hope I don't get too worried by this. The GDP of Scotland is 106 billion, I think. You said if that's right, and you looked at. So this is not a currency board. So this is not the reserves for a currency board. This is the 150 billion. But I think you said that in the case of a much smaller country, a less sophisticated country, you need, in order to have a sterlingization or dollarization, as opposed to a currency board, you needed reserves of something in the proportion of 25% of GDP. In a more sophisticated country like Hong Kong would be about 110% of GDP without a currency board.
Yeah.
And given the fact that Scotland's banking assets are something in the region of 10 times their GDP, I think it's fair to assume that Scotland is a pretty sophisticated economy. Does that imply, just on the maths without any judgment, that we're looking at reserves sort of in the requirement of 110% of GDP for a country like Scotland?
Well, I prefer to just observe the scale of reserves that Hong Kong. The example we've discussed,
which is a currency board,
and I think it was Pat McFadden who raised it in March, if memory serves, was Hong Kong with the currency board, sophisticated financial system, $300 billion of reserves, which was more than 100% of GDP, Hong Kong GDP. And I would reconcile, by the way, as we're going back and forth between various sizes of Scottish GDP, it's an onshore-offshore question in terms of the oil and gas industry, which is obviously considerable importance.
But it's nonetheless it's going to be a significant number in the order of magnitude of broadly speaking around 100% of GDP in the broadest sense. Or would you rather not?
I just to be consistent, I just resisted the effective line of questioning from Mr. Norman asking for the same thing. So I think stand by my responses in March, the way I encapsulated them in terms of my response to the first question. These are the factors that determine relative success. One of the factors is reserves, the credibility of the backing through the lender of last resort, through the deposit insurance scheme of the currency and the broad money, I should say, the broad money. One of the factors that influences that is the size of the reserves that itself is a function of other things. There is a range of examples out there, and
you'll furnish us with a
we'll furnish you with the examples and leave the precise calculations for others.
Just a very sort of quick thing. Do you know what percentage of GDP financial services contributes to Scotland? Off the top of your head.
It's in the low single digit. It is a higher percentage than the rest of the country, but it's low single.
So it's
digit.
about 11%, I reckon.
Sorry, low double digits, but 10, 11%. Yeah.
Okay.
Yeah.
Fantastic.
Sorry, low double digits. That's something. Yeah.
You'll be pleased to hear I'm going to move on to unemployment. Dr. Wheel, if I may, can I turn to you? Thank you very much, Governor.
Yeah. Thank you.
Unemployment is obviously a very big issue. Sorry, not unemployment, immigration. I do apologise, immigration. Big issue. People talk about a great deal at the moment in the UK. Would you be able to give us an assessment of what the effect on wage inflation or deflation immigration is having in the UK?
Well, I think that there have been a number of different views on that. From the committee's point of view, what we do is look at the overall picture of labour market pressures, and that the way I look at inflation, and I did talk about it in June, is that it depends on unemployment relative to some estimate of medium-term unemployment. Now, of course, you can't actually observe medium-term unemployment. The bank has produced estimates of that, and recently we have found that wage inflation has been lower than our medium-term estimates of unemployment suggested, and that led me to suggest that a strong possibility was that actually the labour market was working rather better. I should say there are some other ways in which the labour market and spare capacity in the labour market may influence inflation. Some people have taken the view that there's an appreciable number of people who would like to be working longer hours than they do actually work, and so they're in some sense like unemployed people now. My own sense has been that actually those people, when they do find themselves working longer hours, aren't quite as Stakhanovite as they had suggested when they answered the original questionnaire. Now, I'm sorry that's not answering directly your question, but I'm describing the way I look at wage inflation, and that's from the balance of pressures in the labour market.
But essentially it's going to slightly deflate wage. I mean the fact that wages have gone up by less than inflation over the last few years could be, to a certain extent, explained a little bit by partly by austerity, but also partly by immigration.
Well, I think the main reason why wages had gone up by less than inflation is because, at least until very recently, output had been lower than it was before the crisis. At the same time, we know the number of hours of work that people have worked have gone up, and that's a smaller cake divided among more hours working, so you would expect real wages to have been depressed, and the mechanism by which that happened was through wages rising by less than inflation. Could I make one other point, please, which is that recently average weekly earnings, the measure of earnings that the ONS publishes on a monthly basis, and a measure I think I know quite a lot about, recently that has been very weak. When I go and visit businesses, as I was doing on Monday and yesterday in the northeast, people are talking about pay increases of 2 to 3%, whereas 2 years ago one was hearing a lot of firms saying they were having wage rises. And so we have looked into the question, why might there be this discrepancy? And in some sense it's the factor that the Governor mentioned earlier, that recently people seem to have been hiring less skilled forms of labour. So when you look at the average figure, a change in the mix may also tend to depress the average.
Do you think, obviously immigration is not reaching the targets that the government originally set itself at the beginning of this term. Do you think that this failure to reach this target actually is as a result of more people coming into work in the UK because of the success of our economy? So because our economy is doing better than in Europe, people are coming here to find jobs whereas they couldn't find them there. And that actually this, whilst it's not necessarily welcomed by the general public, actually could be seen as a sign of the success of economic policy.
Well, no, there was a period when the economy was growing less rapidly than the continental economies. At the moment, it seems to be growing more rapidly. Obviously, some people do look for opportunities, and naturally they take the opportunities that they find. But as I say, the main factors from our point of view are the balance of supply relative to demand in the labour market, and I think I've described the way in which at least I find it helpful to look at that.
Yeah, sure. Does anybody disagree with any of that or want to comment on that? No, fine. Thank you.
George Moody.
Governor, I've tried my best, but I kind of find a Scottish aspect of the questions I'm going to ask you. I thought I'd come into Scottish affairs when I was late. I also asked Mark, because we were covering the same area, what he was doing, and he said immigration. And I thought it was about borders between us and England. But you'll be relieved to hear these are just straightforward, kind of straightforward questions. But you said there were two hard calls on the question of employment. One was more slack in the economy, which would affect your decision. And the second one was you see a lower medium-term equilibrium rate of unemployment. Now, for the people who watch us on a Saturday night or a Sunday, can you tell us what that means in non-economic language? Secondly, and more importantly, really, could you tell me, the bank staff have a level at the moment, but they see that going down, I think, to 4.8 or something. Or, well, you'll give me the figures. You'll give me the exact figures.
Sorry, I didn't catch which figure you're asking for again. I'm sorry.
Sorry?
I didn't catch, Mr. Moody, which figure you were asking for. I missed
at what rate that you would reach that equilibrium.
Oh, I see.
And it was in the 6s, and I think the bank staff are suggesting it's in the 4.8 or something. What I really want to know is, if the bank's figures, and I'm no quibbling them, if the 4.8 was the figure where you decided this was the time to follow the hawks, what would be the total number of unemployed people at that stage?
The first aspect of your question, what is the medium-term equilibrium rate of unemployment? And that is the rate of unemployment that, if we were at that rate of unemployment and firms were operating at normal capacity, full capacity.
Or at capacity.
Yeah, capacity. Then inflation would be at target, at the 2% target, and it wouldn't accelerate up and it wouldn't fall down. So we'd be in balance. Now, if I may, and before I get to the second point, Mr. Wheel said something, Dr. Wheel said something a moment ago which is important, which is that one of the things we've observed has been a more rapid absorption of longer-term unemployed. People who have been longer-term unemployed have come into the labor force a little more rapidly, back into work,
yes,
more rapidly than we would have expected. And that's helped us, or that's one of the factors prompted us to lower our estimate of that medium-term equilibrium rate of unemployment. It's important because it's where we can get the economy to before without inflation accelerating once we get to there. And it gets to a real point, with which you'd be familiar, is the challenge is that when people are unemployed, the longer they're unemployed, the more they lose their skills, detachment from the labor market, the tougher it is to get them back into employment. And so the very positive dynamic of the UK labor market in recent years has been the speed with which the unemployed have found work. Now, there's lots more people out there looking for work, and people who found work might want to work longer, and has been suggested they may not be in exactly the right jobs for their skills, et cetera, et cetera. So there still is that slack, which we brought together in this best collective judgment around 1% of GDP. But we have been tracking what's been going on in the jobs market very closely, and we've been updating with each inflation report what our estimate of what the economy can sustain, the level of unemployment the economy can sustain, working at full capacity, keeping inflation on target. And it has been coming down because of this performance. So the second part of your question, if I may, was
just the numbers. I mean, if you had their suggestion.
Oh, in terms of well, I will say I'm not going to be able to do the calculation in my head. The consistent with the forecast, if I may, though, which between today unemployment at 6.4% and at the end of the forecast horizon,
which equates to something like 2.08 million people. So 5. It equates
to the 5.5, a little less than 5.5% unemployment at the end of the forecast horizon is about another 1.2 million people in work.
Dr. Shafiq, you haven't been allowed to go so far.
1.2 million people in work over that period, and yeah.
I mean,
this is
so that would be
confirmed.
Tell me how many people that would be unemployed when you were at that level of equilibrium. I'm not being funny. I'm just after.
Yeah, no, I understand. I'm trying to recall the size of the labor force at that point because we updated the participation rate, which goes.
I mean, I'm not being funny, but this is what distresses me. Up in the north, Yorkshire, Leeds, in the inner city, that's just no phrase. They're not just a percentage. They're people, and you're all settling the rate and deciding, some of you, that the interest rate should go up. That would make it harder for those people to find work. And yet, you don't know, just off the top of your head, the number of people you're condemning to unemployment. Well, but that distresses me. But never mind. Come on. What figure have we agreed on? 1 point...
Sorry.
Well, just give me a figure.
Well, the labour force is about 30... The number of people employed is a bit over 30 million. If you add in the unemployed, it's about 33 million. So 10% of that would be about 1.7 million off the top of my head.
With the greatest of respect, we know at 6 point, whatever the unemployment figure is at the moment, that equates to the present unemployment level of 2,080,000 people. Yes? So...
Yes. That's the claimant. That's actually the people.
Yeah,
but this is the difference. If I may, Mr. Moody.
Yeah, no, but don't let's forget it would be higher if we actually included people who don't register for employment.
Sorry,
right.
It is about double the amount who are claiming the actual unemployed. So because the claimant count is closer to 3. So the unemployed, as David was just moving towards.
So is how many? How many are you going to, David? What's the total?
Well, if you thought 5% was where you could get to in equilibrium and that would be okay and inflation could be at the target level, which seems to me pretty plausible, 5% just mechanically of the labour force of about 33 million, roughly, people is, about 1.7 million, just 5% of that number.
So 1.7 million. What is, as economists, what is the figure that you are comfortable with as unemployed in terms of the short-term people who are out and in? There's a number we would expect in a normal economy to be out of work to enable it to run with liquidity, you can almost say, human liquidity.
Well, that, if I may, I mean, that's where you started in terms of percentages. So it's that medium-term equilibrium rate of unemployment that is consistent. When you say as economists or as policymakers, what's the level, the rate of unemployment that's consistent
No,
with
surely,
that?
Governor, it isn't. The way, put me right, as you always do, but put me right. As I understood the situation, that meant that when wage inflation took off because we were working at capacity and industries couldn't get people, they increased the wages which feed through to inflation and feed to you taking a decision, monetary policy. We'll better calm the thing down by putting up interest rates. Is that not right, David? You shook your head there.
I mean, I think the number you're talking about, in a sense, is pretty close to the number we're talking about, which some people call it the natural rate, the neutral rate. It's the number that might be of the order of 5%.
Look, I'm not quibbling about your figures. Let me tell you where I'm going. if there's 1 point, what did you say, 1.2, 1.3?
1.7.
1.7.
That was roughly 5% of the
unemployed. How many we subtract from those a number that will always be unemployed, not as individuals but as a number, maybe £500,000 that we need to put some human liquidity into the system. The others are wanting work, right? Aren't they? They're available they're wanting work. Now, if you settle equilibrium too soon, you actually are talking about, yes, no, I understand.
Yeah.
If you stop it too soon, they are condemned to finding a job even more difficult.
Sorry. I mean, Mr. Moody,
I prefer the governor to speak. You're someone who would prefer to do that, but the governor's got some compassion. Right, come on then.
Equal levels of compassion across the Monetary Policy Committee, Mr. Moody, but there's differences of opinion in part about where that number would be. That's one of the factors. Yeah. But I would say that, Mr. Moody, no, where the committee has been updating the estimate of that number, amongst other things. We have been learning with the labor market, performance of the labor market, we've been bringing that number down, the degree of confidence. That is a very important reason why the committee collectively has decided not to tighten monetary policy. And the expectation is that we'll continue to grow jobs. I gave you the figure of the total amount, and that wages are going to pick up before it is...
Yeah, I'm glad you've done that. I'm glad you've still got a majority, Governor. But what in your report you indicate that IT, construction and manufacturing are all starting to experience tightening of recruitment. Is there a scenario where the shortage of skilled people mean that your equilibrium is reached sooner? The wage inflation effect means you have to take a decision on interest rates sooner than you anticipate? Or is my fear about this unfounded?
Well, what matters is the average wage growth across the economy, the averages, and very importantly, those averages relative to productivity across the economy. So the growth overall in unit labor costs, we have room. The judgment of the committee is we have further room to go in using up the slack in the labor market. Of course, as the labor market tightens, a couple of things are going to happen. One, you're going to see new recruits get higher pay packages to attract them in, and you're going to see tightness in certain sectors. That's natural. These are leading indicators of tightening in the labor market, but they are not decisive indicators in the judgment of certainly my own personal judgment and shared by others on the committee.
I've got another two, Chairman. I'll put a Scottish one in and you'll give me time, I suppose. But do you not think, or are you worried about the fact that we're so soon coming out of a recession and we're already starting to fear skill shortages?
From a broader perspective, there is concern in terms of matching in the labor market, and without question, and it was a subject at the TUC the last several days, Congress, has been that this continual need to upgrade skills across the economy. So yes, and it is something we hear constantly about skill shortages.
Yes. I'll do my second question with the permission of the Chair.
You'd have permission.
Thank you. It's in two parts. The first part is when the Chancellor gave you the new remit in 13 at the budget, he avoided giving you a dual mandate. But he did say you should have consideration to the economy when you were dealing with inflation. He said then one of the aspects of that would be better communication between yourselves at the bank and the Treasury. If the Monetary Policy Committee understand the importance of skill shortages and the bad effect it would have on the economy. Has any communication taken place between yourselves and the Treasury on that matter? And if not, why not? The second one is in terms of immigration. Some people, certainly people who are left out the labour market in the inner cities, get very upset about people coming from other countries in Europe and finding jobs easily. They overlook the fact that these people are coming with skills, and that's the reason. You don't seem to, in your reports, seem to build that into capacity or future capacity. The fact that we're not looking as we might have looked 10 years ago at a fixed UK labour force, but we have a capacity to pull people in, skills in from the rest of Europe. Do you actually take that into consideration?
We do take it into consideration. We look at, for example...
you just don't mention it, you see. That's
we haven't
yeah.
mentioned in terms of the hierarchy of things at the moment, but it is true that, we track, or we follow the data that's tracked by others in terms of nationality of new employees, residency of new employees. We look at the split over various cohorts, and you look at in terms of since 2008, for example, UK nationals relative of the million-plus jobs that have been created, about a little more than 60% absorbed by UK nationals. But there has been an important amount of labor supply of new workers coming, as there has been in the past prior to the recession from elsewhere in the European Union. On coordination with the Treasury, I'll speak at my level, that have had discussions with the Chancellor on a wide range of aspects of the labour market, as you would expect, including skills. Those would take place also at other levels of the bank, and they are aware. The Treasury is briefed, as well as what we're hearing in the field by our agents in terms of issues such as skilled shortages and analysis that we do. So yes.
Steve Baker has one quick rejoinder.
I'm absolutely certain that everybody here wants real wages to rise. The questions are how and who gets the credit. But Governor, when you said to the Trade Union Congress, you will ultimately determine the size of Britain's pay rise, were you encouraging them to take industrial action to force up pay rates or something else?
No, you've, I'm afraid, taken my remarks out of context, and I'm shocked to have that happen. The preceding paragraphs, and in fact the speech, builds up the point around growing productivity. Ultimately, real wages are going to track productivity. The question, what we can do is we can help bring the economy to its current potential over our forecast horizon. We're not the ones who are going to drive productivity. The U refers to unions, workers, businesses, and governments in setting policies, including around skills, that will determine that potential rate of growth. And Mr. Moody's line of questioning around skills is bang on, because that's what's going to be needed to boost up productivity.
Thank you. David Ruffley.
Dr. Wheel, do you disagree with the central inflation forecast?
Well, I do fear that the inflation pressures are going to be slightly stronger than the central forecast. That indeed is the reason why in August I voted the way I did. I mean, could I also say that a separate and material factor is that for perhaps up to 3 years I was coming to this committee along with my then colleagues saying that we were looking through the effects of the exchange rate fall and the oil price rise on the inflation rate. Now, having said that, when the exchange rate had fallen and the oil price had risen, I similarly need to feel that I should look through that when, at least until recently, the exchange rate has risen and fuel prices have fallen. And how important is that? Well, on page 32 of the inflation report, we say that the peak impact of the effects of the appreciation of sterling on the inflation rate is about 0.5 percentage point. So the amount that I'm wanting to look through isn't trivial.
what would you say were the main points of disagreement between your position and the majority of the MPC?
Well, I'm always nervous of trying to speak for my colleagues, although
I'm not.
Fortunately, there are three of them here too.
I think a lot of people just would like to understand
what
your major point of difference is.
Absolutely.
Or differences are.
And over and above the point I've made about looking through these one-off influences, I suppose the other issue is whether one should wait to see signs of movement, acceleration in wage rates, or whether we should make the first move with some anticipation of them. And I can see arguments both ways. What tipped my view in favour of anticipating them is that although one never knows quite what to make of it, the businesses I talk to do talk about pay pressures tightening. They talk about how they're having to pay more for new recruits than they're paying their existing staff. And most recently we have seen some signs of labour market turnover picking up, which may be an indicator that an acceleration of wage growth isn't very far around the corner.
Dr. Shafiq, could I ask you why, if this evidence of private sector wage increases that Dr. Wheel has obviously placed a bit of weight on, why you think he's wrong? What evidence is he looking at, and what evidence are you and your colleagues looking at that leads you to a different conclusion?
I mean, I think as Dr. Wheeler said, there are forward-looking indicators of the prospect of wage growth. The REX survey, for example, which looks at wages of new recruits, for example, is anticipating a 2% wage rise by December. We at the bank and the committee look at a variety of models that forecast prospective wage growth. We have about a half a dozen different ways of forecasting that. All of those seem to point to the fact that wage growth is imminent, on average, maybe about 1.5%. But I think those models and those forecasts and those forward indicators have indicated that wage growth is imminent in the past, and the actual data has disappointed us. So I think it's that sense that even though we anticipate wage growth coming, we've been disappointed in the past, made me feel, and I think other members of the committee feel, that it's too early to make that decision.
Were you at all close to voting for a rate rise, Dr. Shafiq?
Well, I think,
You're still on your probationary period.
Not at all. Not at all. I'm just.
Yes. No, I mean, I think I voted the way I did because I felt that on balance, and I think, the reason we have a committee is that these are based on judgments. The numbers only tell us so much. And my judgment was it was premature given the balance of what we anticipated happening to wages, what had happened, how productivity has continued to disappoint, the prospects of growth returning to some lower level over the course of the forecast period. So on balance, given the key judgments that we had to make on the path of growth, the path of productivity, the path of wages, and labour force participation, I felt that on balance it was premature because the risks of moving now exceeded the benefits of preempting inflation, which so far hasn't appeared. And the fact that the CPI came out at 1.6 after our meeting, I think, confirmed that judgment was appropriate.
Before the next monthly meeting, what indicator would have to change for you to warrant a rise in the policy rate?
Well, I think like all members of the committee, none of us, hitch our star to one indicator. I think we look at a broad array of indicators. I think at this juncture, a key indicator would be the relationship between wage growth and productivity, and the prospects of that indicator going forward. But having said that, that is a key domestic driver of domestic inflation. But we would also need to look, I think, as Dr. Wheel has pointed out, at what's happening to international prices, the exchange rate, commodity prices, and so on. But at this juncture, I think that relationship between wages and productivity would be quite important.
I mean, given that real wages relative to capital have fallen, do you think the productivity puzzle, a big part of it is labour substitution for capital?
Mm. I think that is part of the story, and that is part of the story of this increasingly high participation rate, which has now reached about 64%. Productivity in the first quarter this year disappointed. It was about 0.4% relative to historical average of about 2.5%. So we're way below the kind of productivity recovery that we would like to see. And the changes, the structural changes that we're seeing in the labour market are an important part of that story. I think, though, to be honest with you, I don't think we've got to the bottom of the productivity puzzle yet. And the variety of some of the explanations have fallen away, but we're still left with several potential explanations.
And just finally, Dr. Shafiq, in the governor's speech yesterday, he noted that owing to the differing labour market responses to the economic crisis, and I quote, monetary policy in the US, Euro area and UK can be expected to be less synchronised than in recent years. Just drawing on your international economic experience and your knowledge of the UK economy, what implications would that lack of synchronisation have potentially for the UK? Why does it matter? Or how might it matter?
Yes. From a I'll start with a global perspective and then turn to the implications for the UK. From a global perspective, it reduces the risk that you have a synchronized rise in rates across the world, and then that results in a sort of massive global adjustment away from riskier assets and so on. So that has the lack of synchronization is advantageous from a global stability perspective. For the UK, of course, the risk of being the first mover is that it has implications for the exchange rate. And that, of course, has implications for inflation and the overall macroeconomy.
But it could be benign in terms of imported prices being lower if the sterling strengthens.
That's the upside.
But are there any other
It's good for
implications?
inflation. It's bad for the current account.
Yeah. I know. Sure. But I mean, if you just unpack what this lack of synchronisation, because of the performance of our labour market, might have prompted this lack of synchronisation. What other effects might it have? Why does it? Could I ask the governor why did you draw attention to it in your speech?
Well, because the underlying, I was trying to build up, making 2 points. First, broad direction of policy. I mean, we've seen important moves recently by the ECB in one direction, significant further easing of policy. The broad direction of policy in the United Kingdom is, in my judgment, will be a tightening of policy. If I make this point, which is that just to put all of this in context in terms of timing and path of monetary policy, the MPC's forecast has inflation returning from a low level, current levels, dipping down a bit, we expect in the next few readings, but below the inflation target, returning back to the inflation target in 3 years, over the entirety of the forecast horizon. We're in a position where we have very low unit labor cost growth. We have average wages growing less than 1%, and we don't expect either of those to persist. We expect those to start to pick up. But we want the mass of opinion wants more evidence of that pickup, and in the context of a benign inflation environment to begin with, and a very slow return to the inflation target, using a lot of our flexibility in our mandate to get back to target. In that context, people voted the way they did in August and September. But consistent with the normalization of the economy, consistent with the progress of that forecast, that is consistent with a tightening of policy in the UK, which is obviously in the opposite direction of the Eurozone. So I wanted to draw attention to that. And then I wanted to go on to explain why that was the case, and at the core of that is the differing performance of the labor markets, and what we're using to judge, or at least I'm using to judge, developments in the UK labor markets. And the message was, as you've seen, because you read the speech, was that people should expect interest rates to rise. Our forecast has them rising by the spring. That just uses a market curve. But equally, as we've stressed on countless occasions now, our expectation, it's not a promise, but our expectation is that over the medium term those increases will be limited, and that process will be gradual for a variety of short and medium term factors that are affecting our economy.
Thank you.
Andy Love.
Governor, in the minutes of the August meeting, it was noted that the committee's guidance on the likely pace and extent of interest rate rises was an expectation, not a promise. Why did you make that promise?
Well, we have said from the start, we first put in place that guidance in February, in the February inflation report, and in the box in the inflation report where we described that guidance, we made the point that if the economy, if economic events proved materially different from our core expectation, then we would adjust policy accordingly. We would expect us to adjust policy consistent with achieving the inflation target. Using the phrase expectation, not a promise, not a guarantee, in other words, is just a tighter way of expressing the same sentiment that we had been stressing since February.
Was part of the reason that market participants were placing too much emphasis on the guidance?
I hesitate to judge that. I think the reasons behind, I'll speak personally, the reasons why I expect the path of policy to be gradual and interest rates to rise when they begin to rise to a limited extent are several. There are several major factors that are weighing on this economy. They start with the weakness abroad of our major export market. They extend to the ongoing fiscal adjustment, fiscal consolidation, and very importantly, and we've talked very little about this, household balance sheet repair, the scale of debt on households, and in an environment where there's been an absence to date of real wage increases. We're just talking about prospective real wage increases. That debt burden has not lessened for a large number of households, and so in that environment one can expect potentially a larger reaction to an adjustment in interest rates than we would have seen in previous environments. But it extends further to medium-term factors, which include the ultimate impact and equilibrium that comes from financial reform, to broader savings investment imbalances in the global economy. So there are a variety of factors behind that expectation. And if I may, I think it really is a question of degree as opposed to whether it will be fulfilled, but we try to make that clear.
But given all those caveats, including dependent on economic conditions, which I noticed you repeated yesterday at the TUC, what is the point of this guidance?
Well, I'd flip it around. Your previous question was, were market participants putting too much weight on it, which suggests the market participants have put some weight on it. I think if you do look at broader developments in financial markets, interest rate future markets, forward curves, both in the U.S. and the United Kingdom, where there has been this guidance since it was put in place in February, March, there have been moves towards limited and gradual. I'm not going to judge the degree of those medium-term moves. There are some other factors that are driving, most recently, the developments in Europe, presumably are driving some yield movements in other major bond markets. But there has been elements of this have been taken on by market participants. They're free to do so or not. The other point, though, is that when one goes around to speak to businesses, they're not as obsessed with what's going to happen in the short term. In other words, they're not obsessed about when is the first rate rise. They're thinking about their hiring investment plans. They're thinking about the medium term and providing them a perspective as best we can about what's going to happen in the medium term. I've always found this has been quite helpful. Now, we're not going to oversell it. It's an expectation, not a promise. But it is an expectation that's grounded in some pretty big economic forces that are facing this economy today and will continue to do so for some time.
But the more we depend on formulations like dependent on economic circumstances, aren't we moving back into a situation that existed in the pre-guidance world? Isn't that what we've always done, dependent on economic conditions?
Well, it's always what we did in the. It's always what we've done. There have been when we've been in extreme circumstances, we've been able to provide clearer guidance. We provided clear guidance a little more than a year ago using a threshold. We provided this guidance around the medium term. We provided guidance around what we intend to do with our asset purchase facilities. But we're in a process. We're trying to contribute to a process of normalization of this economy. And the more this economy normalizes, the more monetary policy can normalize. I don't think, though, in my judgment, it is yet time to underplay the exceptional circumstances we remain in. Interest rates are still at the zero lower bound. We still have substantial spare capacity. We still have all other major central banks engaged in quantitative easing now. The U.S. is at the tail end, but they're still actively engaging in quantitative easing. We still have a global economy that is growing below trend. And we still have extraordinary weights of debt. Or I will put it a different way, there's still significant balance sheet repair that's required both in the public and private sectors in this country. So might want to get back to the old days, but it's going to be a while yet.
I take the point you make about the exceptional circumstances we're in, and that requires, or did require, some guidance. But don't you accept that we've moved from forward guidance to what was described in the media as fuzzy guidance? And to counter arguments of inconsistency, you've introduced dependent on economic conditions. But aren't we in fact seeing the end of the guidance process? And wouldn't it be better to announce that rather than to let it seep into the public domain?
Well, I think certainly the first phase of guidance was cleaner, was harder, was clearer with a specific threshold, but that was an easier call. That was a very easy call. There's substantial slack in the economy, and saying we weren't even going to begin to think about raising interest rates until the unemployment rate got down to 7% was the right thing to do, and it had an impact. And lo and behold, the committee judged unanimously when the unemployment rate got down to 7% that it was not time to raise interest rates. So the guidance was effective, and it helped serve that. Yes, the guidance we're giving now is not as hard as the guidance we gave before. It's softer, if you will. It's qualitative. It's towards the medium term. But
what is the difference between your words, guidance you're giving now, and what was given throughout the whole history of the MPC in terms of relying on economic conditions?
Well, the difference is the substantive difference starts with what we intend to do with 375 billion of gilts, where there's hard guidance both about reinvestment and the point at which we would begin to consider sales of those gilts. So that's one. Secondly, there is guidance that's built on the economics around the medium-term path of interest rates, which is not just reliant on where the market is, just a mechanical use of a market curve and a forecast, but actually provides guidance to markets and to businesses. And everything is dependent on economic circumstances, but it is substantive, and it is consistent with adjustments in expectations.
Sorry to interrupt, but just to follow Andy Love's question there, I didn't quite work out what the new fuzzy guidance had with respect to the second of the two items you listed. The first on QE is clear enough.
The first on QE, you mean in terms of reinvestment? We will reinvest up until. Well, we provided in the May report the guidance. In fact, filling up on a conversation we had this committee that
I remember it well. That's why
we would not engage in asset sales until bank rate had been raised to a level from which it could be materially lowered if stimulus were required in the future. And that is guidance that the committee has given.
Now, I'm just trying to get back to what this new guidance is offering with respect to judgments on the state of the economy beyond the approach that was being used prior to the issue of guidance.
I'm sorry?
We had a system in place where judgments were made about the economy.
There is
as Andy said a moment ago,
there's a
since
judgment.
the MPC's been in existence, and what we want to know is what's new in that respect, excluding the QE aspect, with fuzzy guidance or guidance Mark 2 or
Mark 3.
May I ask you, Chair, what guidance have we given on the expected path of interest rates over the medium term?
Fortunately, I do the asking of the questions.
Yeah. The answer to that is we expect that the path of interest rates is going to be the path of interest rates will move more gradually and to a more limited extent in this tightening cycle than it has in the past. Since we provided that guidance, financial markets have moved consistent with that guidance. Businesses understand what that means. We've talked in terms of what the historic medium-term equilibrium interest rate has been in this economy. It's been around 5%. That we would expect that over the medium term, the bank rate consistent with this economy operating at full capacity and inflation remaining at target would be materially lower than that. That's guidance. That's guidance.
Sorry, Andrew, I didn't.
And there's a very handy clarification of it in 60 words in one of the national newspapers. I can send it to you. That was published. That was not an op-ed from the Bank of England. It was penned by one of that.
Forward guidance was always meant to be temporary. When do you see it coming to an end, and what will be the circumstances? Will it be the first rate increase? Will it be dealing with the 375 billion? Will it be the exceptional circumstances of the economy?
Yeah.
How do you see this issue going forward, and when will forward guidance come to an end?
Well, a couple of points, and speak in general terms. Part of the point of providing this guidance is helping to manage an exit from an extraordinary, if not emergency, settings of monetary policy. That's why we have 375 billion of gilts in the asset purchase facility, why we have interest rates at as low as they possibly can go. So part of it is managing that exit. There's a judgment. It's a judgment for the committee as we go through that process of normalization when we have effectively moved out of exceptional circumstances, and whether there still merits, there's still utility, there's still value in providing additional guidance, and in addition, whether there's still sufficient consensus to provide guidance, particularly about the medium term. So part of this is very much about a process of normalization and managing an exit. I would suggest that certainly with respect to assets, the guidance we've already given around the asset purchase facility indicates that the exit is not achieved on the day that we have the first rate increase, because our guidance stands well beyond that.
John Mann.
How can you determine when forward guidance is going to end, considering that it was instigated by the Chancellor in his budget in March 2013 in a request several months before you arrived?
I personally cannot determine it, because it is a determination of the Monetary Policy Committee, but it is a determination of the Monetary Policy Committee. The Chancellor's remit letter to Governor King asked for the committee to look into the utility of forward guidance as an instrument, not as it's not a mandate of the MPC.
It was a hint, though, I think. But when does summer begin?
I'm sorry.
When does summer begin in the United Kingdom?
You're looking forward to right? June 21st. June 21st.
That's your definition of summer.
I'm steady on you. The Canadian, where can't expect him to know exactly when summer begins. I can't remember
No,
myself.
no,
If anybody here knows when summer begins,
my question,
they're welcome to tell us.
I'm not asking a factual question, Chairman. I'm asking what the Governor's interpretation of when summer in the United Kingdom begins.
Wow. This is...
we can move on.
John. No. I'd like to know when the Governor believes, in his terms, his definitions.
In calendar terms, June 21st.
Right, now that's the reason for asking is I could have asked when spring was, because you're suggesting that the rate rise on current forecasts is likely to be by spring, but everyone else, well, not everyone, but most people would deem summer to come in at the beginning of May.
By spring, the passage you're referring to relates to the forecast that is in the inflation report that we're discussing. The forecast uses a market curve, so the curve in the market for forward interest rates that was in place at the time we put together this forecast. That market curve had an increase in interest rates in February of 2015, which is by spring, by the time spring begins. So that is what, which it refers. I didn't give the exact date of the market forecast for the purposes of speaking to the TUC, but that is what is in this forecast.
And that hasn't changed?
The inflation. Well, our forecast is not going to change until the November inflation report. No.
I'm just trying to ascertain whether spring had changed.
But to be clear, just to be clear, Mr. Mann, what I said in my speech was our forecast is conditioned. This forecast is conditioned on a market curve that has an interest rate. First interest rate rise by spring, and then it rises gently thereafter, which was consistent with the market curve. In that forecast, with that profile, as I said in reference to Mr. Ruffley earlier, inflation, even with that slow general profile, inflation just gets back to target over the 3-year forecast horizon, which provides some context to the decisions that the MPC are.
So at the current time, you're suggesting by mid-February then?
I'm observing that consistent with the inflation report. But I can assure you that there will be a number of events that happen between now and then, as I also said in that speech, that will adjust if it looks like we're going to use up the slack in the economy sooner.
Well,
we will adjust accordingly.
One big event that might impact on things.
No, you couldn't be referring to a general election.
And
John, could you, by any chance?
No. I'm more interested in the next 2 weeks now. Is we've got all this forward guidance, but there are other events where there's scenario planning. We've relearned today that it is outside the powers of any independent Scottish government to guarantee that taxes won't rise or spending cut in order to create money for reserves. That's not a guarantee that they can give, because any other scenario will be dependent on negotiations, which by definition they can't guarantee. Why isn't all your scenario planning on Scottish options being made public?
We're moving from monetary policy to financial stability. Because in monetary policy, we do not condition certainly our forecasts on the basis of political events. You would not expect us to forecast political events, and we deal with the realities that exist. Our contingency planning for financial stability purposes has been conducted. We have contingency plans. And the reason we don't make them public because they relate to specific institutions and specific situations. And from considerable experience, making plans public about specific institutions' situations can be counterproductive.
But wouldn't it be helpful to people in Scotland to see what some of the scenarios are in relation to some of the consequences should they decide to change the status quo?
I think the points I'd make are that the Bank of England is a principal actor in terms of promoting financial stability. We're not the only one with responsibility, but we have considerable responsibilities for financial stability. We take those seriously, as you'd expect. You hold us to account on those. We've made contingency plans. We will be the continuing authority for financial stability, regardless of the outcome. Now, if it were to be a yes vote, we would be the continuing authority for 18 months for that transition period. So that's what we plan for. What I would and the people of the United Kingdom, regardless of where they live, can expect us to do that. They should expect us to do that. We're prepared. A judgment for the Scottish people, as per the previous discussions, is what happens after that and what plans are being put in place, because there's certain scenarios. I don't want to prejudge political discussions, but there's certainly scenarios where the Bank of England has no continuing responsibility for financial stability.
I don't know. It would be totally wrong for you or anyone involved in the bank to either prejudge or to have a public view or to have a biased approach. However, is it not in the public interest that the different scenarios of what might happen and its impact in relation to your work and the bank's work not be made public?
What we have made public are the very considerable economic issues that relate to currency arrangements, which we've discussed here today and other occasions. What I think is in the best interest of the people of the United Kingdom with respect to the next few weeks is that they are aware that we are the continuing authority for financial stability in the United Kingdom, including Scotland, after September 19th, that we've made contingency plans, we have considerable resources, and we will coordinate with our partners.
I mean, of your other three colleagues, would you anticipate that a vote for Scottish independence would impact in the short term on how you might use your vote on the Monetary Policy Committee? Dr. Wheel.
Well, I mean, could I say that I will do what I always do when I vote, whether to keep interest rates unchanged or to change interest rates, and that is to look at the data that we have, the way I interpret them, and obviously know something that we will know in the October meeting that we don't know now is the outcome of the Scottish referendum.
I expect that's what others will want to say, but is there anything anybody wants to add on top of that? The other two? Any other questions?
No, I'm listening to an answer, but I take the silence.
Well, I mean, the issue is whether or not economic events play out in such a way that one's view on the outlook for the economy and where inflation is going, particularly a year, 2 years, 3 years down the road, whether that changes or not. Of course, things could happen. The oil price might move very sharply within the next few days. If that happened, that would change one's view on the inflation outlook. That would have an implication for how you thought about monetary policy.
Yes, you know.
Thank you, Mr. Chairman. Just to return to some other questions. Dr. Shafiq, if I might ask you. Obviously, you would have seen Martin Wolf's piece this morning in the FT, just pointing out that demand is down 5% in the Eurozone after the last 6 years. Unemployment is up 5%. Inflation is basically flat. And so the question is, I mean, is it not the case that actually the Eurozone is at some no little risk of deflation at the moment? And how much of a concern this is to you and what its consequences would be for us?
Yes, you're quite right. I mean, the growth numbers for the Eurozone in the last quarter were very disappointing. The inflation numbers were extremely low. The domestic drivers of inflation in the Eurozone, particularly in the periphery, but also more widespread, are very, very low. So there is a risk of a prolonged period of very low growth and what's now been coined as lowflation. Not deflation, but very, very low rates of inflation, which make balance sheet adjustment, economic adjustment much more difficult, particularly in the periphery. Clearly the ECB is very attuned to this, and the recent actions that they took to lower rates by 10 basis points and bringing the deposit rates into very negative territory is important, and the asset purchase scheme that they've announced is potentially very significant. But I think, as the president of the ECB himself has said, monetary policy can't solve this alone, and there's a need for complementary fiscal and structural measures in the key economies in Europe for this to be successful.
Is that view shared in your counterpart banks across the, I mean, obviously ECB, but do you share the view that the politicians are getting the message in these major countries? Because one's impression is actually not, in many respects. I mean,
yeah.
Germany is coming off the boil, France is in doldrums, Spain, Italy, really risky. We've just seen the failure of a bank in Portugal. I mean, it's extremely worrying.
Yes.
Would you not agree?
It is worrying, and I think what needs to be done is clear. I think there is a question about whether it will be feasible. I think you asked about the implications for the UK. I think the worrying thing for the UK is that it means that our own recovery will continue to depend a lot on domestic factors. We can't, we've had some rebalancing away from consumption toward investment with the strong performance of investment in the recent period. Over 10% growth in investment, which is very good. But the rebalancing that we had hoped for on the external side in terms of having more demand from external factors is not going to show up for a while, I'm afraid.
Yes. Why do you think that the as it were, Eurozone recovery proved to be so ephemeral? I mean, recovery, I put it in inverted commas.
There are difficult structural reforms that have to happen in many Eurozone economies, and there has been, I think that Martin Wolf's arguments about the need for a more growth-friendly fiscal policy is part of the story, but I think there's need for progress on multiple fronts, on fiscal policy, on structural reforms, and on monetary policy, and I think there's been an inability to coordinate those three. I guess now people are calling them the three new arrows, the Draghi three arrows like Abenomics. Those three have been unable to be coordinated politically. So
you sound to me like you're coming close to the kind of throw the kitchen sink at the problem approach that we're sometimes seeing across, some interesting, rather than getting hung up on particular doctrinal arguments within the economics profession.
Yeah, I think you need action on all three fronts. I don't think it's just a demand side story or a supply side story. I think
so something you want to
President said.
Look, I think one of the reasons why call a spade, one of the reasons why the Eurozone recovery has been so weak has been the structure of the currency arrangements in the Eurozone and the difficult adjustments that had to take place in a number of large so-called peripheral economies to effectively have wage deflation in order to reestablish internal competitiveness. And that is an extremely difficult dynamic to manage, and as Dr. Shafiq rightly emphasizes, that if it's not accompanied by all other aspects of policy moving in the right direction. But I don't think we should underplay the contribution of those adjustments to the weakness of the Eurozone.
We always like it when witnesses call a spade a spade.
I thought you did.
Good. And it's
those Scottish spades we were looking.
We've been digging hard but unable to locate them. But hopefully
we found a few actually.
One or two. Let's just focus on one other thing, if I may, which is, do you see any parallels, Governor, between the situation in the Eurozone and what's been happening in Japan?
There are some parallels. I think Eurozone authorities are certainly aware of them. I mean, I think that one of the key parallels has been the slow pace of recapitalization of the banking system, of fixing the banking system, very slow in Japan at that period, and really handicapped the recovery. Similar challenge in Europe, which is now being seized very much through the stress test and the asset quality review. The need for structural reforms, the need for structural reforms on the policy side, then the demographic dynamics in a number of Eurozone economies also mirror some of the challenges in Japan, which just raises the bar for the policy response. But I would not suggest that Europe is condemned to follow that path as Japan, although thus far the real GDP growth in Japan outperforms the Eurozone path thus far. But
we shouldn't look forward to the kind of prosperous stagnation that they've endured for the last 20 years.
Yes. Yeah, I shouldn't. I mean, it's not a laughing matter, but it's
that's interesting.
still to play for.
Yeah. So, Dr. Freak, if I can come back to you then, obviously, in the MPC, you picked up on the failure of the bank, Banco Espírito Santo in Portugal. How far does the state of the European banking system give you pause and present a risk to the Eurozone, do you think? I mean, obviously, we know it's a worry. The question is, how bad is it, and was this a particular canary in a coal mine or something further to come?
Well, this case in Portugal was a bank which was involved in connected party lending. They essentially lent to the family that owned the bank, yes. And created a 3.4 billion euro hole in that bank. Mm-hmm. The Portuguese government has divided up that bank into a good bank and a bad bank, and has done a sort of bail-in to deal with that problem. I say sort of because
it's more like a bailout to me, but yeah.
Well, I say sort of because the senior debtors were protected and put in the good bank, and public money was put in place. I think the good thing is that going forward after 2016, that sort of bail-in will not be allowed under the European rules for resolution, and we'll have to have a much cleaner bail-in. So I think going forward, one has a much better regime for resolving.
Right. So in other words, it would be fair to say that it kind of underlines the toxic links between banks and governments, and you're nodding, and as it were, that will become harder to do after the new rules are implemented.
Correct. After the rules at the BRRD and the FSB.
Final question, obviously, while we're on the banking system. I mean, do you think there's a genuine risk of capital flight in Scotland if there is a referendum? Vote for yes? Given the size of the Scottish banking system relative to the...
I think I'm going to defer to the Governor.
The Bank of England is the continuing authority for financial stability after the referendum, irrespective of the result. Obviously, our contingency plans, which we have developed, we're not developing. We've developed. They're there. We would implement them as necessary.
Yeah,
the ones we're not describing but exist. We would put in place. And that is the assurance we would give. So it's
so if
the issues we have been discussing, if I may, the issues we have been discussing. I understand why you've been asking the questions. Relate to the medium-term arrangements, which are important considerations, but they're the medium-term arrangements. The immediate arrangements, the immediate issues around financial stability remain the responsibility of the Bank of England. With respect to deposit insurance, remains the responsibility of the FSCS, which is backed by the UK government, and I can assure you that we have done our homework.
Yeah, okay. Just to the avoidance of doubt, Scottish banking system dwarfs the size of, as it were,
Scottish
reserves, such as they are, even putatively. Therefore, there is a potential risk of capital flight, and what you're telling us is that amongst these contingency plans that we don't describe, you're not describing, there is cause for confidence that that capital flight features in your plans, and you've got a method of addressing it.
Yeah, the institutions in Scotland have access to Bank of England facilities. Depositors in Scotland are backed by the FSCS.
Right.
But there are reasons why we have contingency plans in place.
Okay. I'm sure that'll be of great comfort to those up north. Thank you very much.
Even by the usual standards of
measuring each word carefully that we've come to expect on the MPC. We've had a double or treble dose today. And we're very grateful for everything. We've heard the sessions taken a bit longer than the 2 hours I normally like to limit these to. And but then again, I think it was the measurement of each word that probably took up much of the extra 20 minutes. Thank you very much indeed for coming to see us.
Thank you.
And no doubt you'll be before us again before too long. And we're looking forward to a note first thing tomorrow morning.
Yes. Thank you very much. Thank you.